Welcome to Stock Incubator. Today we are breaking down the market question behind this story.
Ola Electric is no longer just an IPO hype story. The stock moved from 71 rupees and 25 paise toward the mid-30s. It also tested much lower levels in March. That collapse is the obvious story. The more interesting story is the contradiction underneath it. Your draft data shows mutual funds added more than 1 crore shares in April. That does not prove a recovery. It does not prove the stock has bottomed. It only shows the debate has changed. The market is now asking one sharper question. Is Ola broken, or is the business model being reset before demand comes back? This video studies the constructive case first. Then it stress tests the risks.
The whole Ola Electric story comes down to one tension. Margins improved. Costs fell. Battery integration advanced. But revenue and volumes remain under pressure. That is why this is not a simple positive story. It is also not a simple failure story. The constructive side says the business is getting leaner. The skeptical side says a leaner business still needs buyers. That is the market test. Ola has to prove that cost discipline and vertical integration can matter in a weaker demand cycle. Without that proof, the margin story is incomplete. The strongest constructive signal is gross margin. Your draft shows consolidated gross margin at 34.3% in Q3 FY26. It also shows a 15.7 percentage point expansion year over year. This matters because EV makers can grow fast and still lose money. Unit economics decide whether scale actually helps. Ola says Gen 3 architecture and vertical integration helped the margin reset. That is a real business signal. But it is not enough on its own. A higher margin on weaker volume still leaves the model under pressure. The next question is whether this margin can hold when pricing and competition tighten. The second constructive signal is cost discipline. Your draft shows a sharp operating expense reset. Quarterly OPEX fell from above 840 crore rupees to 484 crore rupees in Q3 FY26. Management has discussed a lower steady-state cost structure. That is why the break-even math matters. If fixed costs are lower, each incremental vehicle can carry more operating leverage. Your draft says EBITDA break-even could move near 15,000 units per month. That number makes the story more interesting. But it is conditional. The math only works if volumes stop deteriorating.
The battery story is a long-term option. Ola is trying to control more of the cell stack through Bharat Cell and the Krishnagiri Gigafactory. Your draft points to 6 GWh of installed capacity. This matters because cells influence cost, supply security, and margin control. If Ola can scale reliable in-house cells, it may become more than a scooter assembler. It could become a more integrated EV platform. That is the constructive version. The cautious version is simple. Battery manufacturing is hard. Quality, yield, safety, and scale all have to be proven over time. This is an option, not a proven advantage.
The mutual fund point needs careful wording. Your draft says mutual funds added more than 1 crore shares in April. That is worth mentioning. But it should not be treated like a verdict. 1 crore shares can sound large. It still has to be viewed against total shares, liquidity, and future holding changes. Funds can add. Funds can reduce. Ownership can rotate quickly. So the right interpretation is measured. Institutional interest may show that some investors are studying the reset. It does not prove the turnaround is working. The evidence still has to come from volumes, margins, service quality, and battery execution. The largest risk is demand. Your draft points to a 55% year-over-year revenue drop in late fiscal 26. That is the number the constructive case has to answer. Cost cuts help. Better gross margin helps. Battery integration may help later. But none of those replace customer demand. If monthly vehicle volumes keep weakening, the business reset loses power. If market share keeps moving toward rivals, the margin story becomes harder to defend. This section should feel direct. Ola does not just need a better cost base. It needs proof that customers are still choosing the brand. Service trust is not a side issue. It is part of the financial story. EV buyers are not only buying range and price. They are buying reliability, repair access, software stability, and confidence after purchase. Your draft references service turnaround, software bugs, and component wear. That section needs to be sharper. If service problems remain visible, new buyers may hesitate. Existing buyers may influence the next buyer. That can pressure demand without showing up immediately in a factory metric. This is where the turnaround can break. A leaner cost structure cannot fully offset weak customer trust.
The competitive risk is getting tougher. Ola is not competing against a frozen market. Legacy two-wheeler companies are expanding electric portfolios. Pure-play rivals are also building service reach. That changes the market test. Ola may have brand awareness, scale ambition, and cell integration. But rivals can fight with dealer networks, financing, reliability, and service familiarity. This is why demand matters so much. If customers trust legacy networks more, Ola has to win with product, price, service, and execution at the same time. The market is not only testing technology. It is testing operating discipline.
The market is still skeptical. That skepticism is reasonable. The stock has been weak. Revenue has fallen sharply. Competition has increased. Service concerns remain important. This is the balance the video needs. The constructive case is real enough to study. But the skeptical case is not noise. A true reset usually needs several quarters of proof. 1 quarter of margin improvement helps. It does not finish the debate. The better framing is simple. Ola has created a path to a cleaner model. Now it has to prove the path with demand, execution, and cash discipline. The clean way to track Ola is through 5 signals. First, monthly vehicle volumes. Second, gross margin durability. Third, operating expense run rate. Fourth, Bharat cell output and quality. Fifth, service turnaround data. These signals keep the story grounded. If volumes improve while margins hold, the reset becomes stronger. If costs fall but sales keep sliding, the model remains fragile. If cell integration scales cleanly, the long-term option improves. If service complaints stay high, customer trust remains a drag. This checklist is not a trade call. It is an evidence map. That is the right way to cover a turnaround story. Ola Electric's constructive side is real enough to analyze. It has margin improvement. It has cost reduction. It has a battery integration strategy. It has some institutional interest in the data you provided. But the risk side is just as real. Demand is weak. Service trust needs improvement. Competition is stronger. Battery execution still has to scale. That makes Ola one of the more interesting Indian EV debates in 2026. Not because the answer is obvious. Because the evidence is split. The next test is whether Ola can turn a leaner model into durable demand and cleaner execution. This content is educational only. It is.